Get your free copy of the complete tutorial at www.teachucomp.com/free.
Before we can create a chart of our business accounts or begin recording financial transactions, we need to understand the types of accounts that we will be creating. The balances from these accounts that you create are displayed in the two most important accounting reports, the balance sheet and the income statement, which is also often called the profit and loss report, or P&L for short. The first types of accounts that we will examine are ones that are shown in our balance sheet. These are the asset, liability, and equity accounts. The accounts that appear in the profit and loss statement are the income and expense accounts. We will examine the purpose of these financial reports at a later point in the course, but it is important to understand that the accounts you create and use will appear in these financial statements. Roughly speaking, the balance sheet of a company shows all the things a company possesses that are of value, which are the assets, and the source of those assets, which are the liability and equity accounts. Since everything that you possess came from some source of cash, the total balance of the asset accounts is always equal to the total sum of the liability and equity accounts. This is why the report is called the balance sheet. In a balance sheet, assets are always listed first, and that is where we will begin our investigation into account types. Assets are the things that your company has or will soon have that are of value. Note that this also includes money customers owe to you. Specifically, the money that people owe you is called your accounts receivable. Other examples of assets may include checking account money, inventory, fixed assets like computers, for example, and undeposited funds received from customers. Within the balance sheet, assets are listed in order of their liquidity. Liquidity means the ease with which the assets can be converted into cash. There are two main groupings of assets within the balance sheet. First shown are the current assets, followed by the non-current assets. Current assets are asset accounts that mature in less than 1 year. The term mature means convert into cash or use up. The current assets contain the following general asset accounts: cash, accounts receivable, inventory, notes receivable, and other current assets, like prepaid expenses, for example. Let's briefly examine the purpose of these asset accounts before we look at each type of asset account in depth. Cash accounts represent the cash available to the business to pay bills and other obligations. Cash accounts include all checking, saving, money market, and petty cash accounts. Cash is an extremely important asset, as if cash is inadequate to pay for the expenses of the company may become insolvent and forced into bankruptcy. Accounts receivable is the money that is owed to the company by its customers. When you send an invoice for payment to a customer, the amount is typically recorded to accounts receivable until the payment is remitted to your company. Inventory is the total value of the products that you sell to your customers. Notes receivable are typically short-term loans that are due to the company. These may be loans to employees or officers, for example. Other current assets is a type of catch-all account that can be used for assets that will mature in the next year, but that do not fall easily into one of the other categories listed. Prepaid expenses are often listed as an other current asset account. Prepaid expenses are amounts that you have paid for expenses not yet incurred. For example, if you prepay 6 months of rent, you can record the amount by which you prepaid the rent to a current asset account, and later transfer the monthly amount to the rent expense account when the expense is actually incurred until the asset is used up. After the current assets in the balance sheet are the non-current assets. Non-current assets are defined as assets that are not expected to be converted into cash or used up within the next year. They can consist of the following asset categories: fixed assets, investments into subsidiaries, intangibles, and other assets. The most commonly used of these are the fixed assets, which are the assets that you buy that assist you in the operation of your business, and this can include things like computers, office furniture, company vehicles, and equipment, for example. Aside from the fixed assets, you also have other assets, such as the cash value of life insurance and retirement accounts. These are great examples of the use of non-current assets in the balance sheet.
Like what you see? Pick up your free copy of the complete tutorial at www.teachucomp.com/free.